Hey, what's up, everyone? Welcome back to my world of stocks. Earnings season, of course, continues for the second quarter. So I've got another weekly recap for you. This time, we'll be running through a couple telecom giants in Verizon and AT&T, a few auto giants in Tesla, GM, and Ford, and what has been really my favorite stock of the past couple years in the tech giant Google. So lots of fun to unpack here. Let's not waste any time. Let's go ahead and jump straight into this. Okay, so let's start here with a couple of telecom giants. First, we have Verizon, who reported on Monday. They had a bit of a mixed showing with subscribers growing, but revenues falling short of analyst expectations, while profits continue to be under pressure from really all the investments that they've made recently into 5G and fiber internet. EPS also came in just barely under estimates, while net income also declined slightly by 1%, as it wasn't really helped by the less than 1% growth that they saw in revenues either. So pretty much flat performance there for Verizon, but you're not really going to be investing in a stock like Verizon right now for getting any kind of growth. If you own it like myself, by the way, then you're really buying it for that cheap valuation and the dominant business that will hopefully stay profitable enough to pay their mouth-watering dividend while also paying back some of their ginormous debt that they carry, just like AT&T, from all of those investments that they've made into their infrastructure, building that out and all that kind of stuff. Which, by the way, thankfully, well, it still seems to be an investment thesis here that is holding up, as free cash flow managed to grow by another $500 million in the 6 months ended, which covers the dividend by about $3 billion, leaving some cash left over to pay down debt as their capital expenditures continue to fall after so many investments have already been made. So now we're kind of seeing the recovery phase where you're starting to bring down some of those investments and having some of that money be able to go into your free cash flow so you can pay the dividend and also pay down some of that enormous debt. Well, the quarter also saw plenty of growth in customer counts, at least on the consumer side of things, but business was a bit of the opposite story there. It actually declined a little, probably given the weak macro economy, as businesses are really starting to tighten down their budgets. So that's probably why you're seeing some weakness there from Verizon on the business side of things, which is normally kind of a strong area for them because they have such high quality that businesses tend to they're willing to pay a premium price for Verizon. But when conditions are just doing so poorly macro wise, well, you're gonna still take some damage there too. But overall, fiber and broadband and wireless, well, those continue to do pretty well. And yet, because of the very slight miss on analyst estimates, well, the stock actually fell about 5% for the week, leaving it still down 34% from the top and at one of the lowest prices really of the past decade. Personally, I've been a buyer at these levels and especially below that because the valuation is just dirt cheap at this point. It's around 30 to 50% lower than the sector, despite them being, market leader, while the dividend is sky high at over a 6.7% yield. So that's what I like about Verizon. Of course, though, one of Verizon's biggest rivals, along with T-Mobile, is AT&T, who also reported this week, and they too had a bit of a mixed bag, beating on EPS by over 10%, as well as subscriber estimates on the back of relatively strong demand for even their higher price plans. However, like Verizon, they also saw growth in most areas except for business, where they actually had almost a 10% decline in sales. And yeah, that's pretty bad. So you can see business, again, businesses pulling back. They're probably going to be pulling back from maybe not as much in Verizon because Verizon at least has the higher quality, but they're probably going to be pulling back a little bit heavier into some of their rivals too. And that's kind of what we saw here. Anyway, this also led to total revenue falling slightly. It was slightly negative for the quarter, while EPS profits fell about 10% too, on an adjusted basis. Like Verizon, though, free cash flow actually increased up to $4.6 billion in total now on the back of lower capital investments, which does easily cover their dividends now of less than half that amount. So again, pulling back investments, that's how you're going to be able to grow your free cash flow if you're these type of companies that you're not finding sales growth, But if you can spend a little less, you'll be able to have enough cash left over to, pay dividend and pay down debts. And while the business segment is struggling because, again, of macro issues, well, the other segments actually did pretty well for AT&T, particularly in fiber internet, where they've now seen over 200,000 net adds for 18 consecutive quarters, and that's pretty good. And that really seemed to be enough to lift up the stock right after reporting, although it was still about flat for the week given the decline that they had right before that, just right before that. And that was probably triggered, by the way, from Verizon's report because they reported a little earlier. Anyway, as for me, I don't really consider AT&T to be a bad alternative to Verizon stock, but just kind of a weaker one that doesn't really attract me as much, as they too are riddled with massive debt, north of $130 billion. And while the stock is also down huge from the top, leaving a cheap valuation, well, the dividend is about 1 percentage point less than Verizon's, because AT&T actually cut their dividend a while back, while their quality of service, I would also argue, is not nearly as good as Verizon's either, who continues to win more awards than AT&T and any other rival year after year. And I do feel that that gives Verizon a key advantage there, like I mentioned earlier, since we're essentially talking about a market here that isn't going to be growing by very much, but rather it's more so about who can just kind of remain dominant. And so I think that that's where the higher quality of service is going to really benefit a player like Verizon, a dominant one who can it'll also help them keep some pricing power over the competition. That's very important. It's going to be even more important going forward. And so that's why I like Verizon just a little bit more. All right, moving on though, we had a few automobile stocks report, and we had Tesla, GM, and Ford all report this week. So let's take a look at how they did one by one. Well, starting with Tesla, of course, one of the most popular stocks in the market, right? Just in general. And like most of the market though, this quarter, they too had mixed results. And we've been seeing that a lot from a lot of companies this quarter, but mostly leaning to the negative side of things. It's been not too impressive of a quarter in my opinion. I've seen a lot of companies kind of disappoint. Anyway, revenues, they did beat estimates, but they only grew by a measly 2%, which is of course horrible performance for what is a very highly valued growth stock like Tesla. You want high growth, not just almost flat performance, right? But that kind of just shows how tough this environment really is right now, which is also hurting their profitability. That's been a major headline when it comes to Tesla, as EPS missed by over 16% and their gross margin continues to trend downward. Now, Tesla did try to do some damage control for this, noting in the report just how challenging this macro environment is right now given our sustained high interest rates, which despite that, they still managed to make lots of progress in certain areas. Like for example, energy. I mean, energy is a huge highlight right now. It's probably the most impressive figure that I've seen, as it doubled. Guys, energy doubled in size in the quarter. And when it is combined with other services from Tesla, those two segments now make up about a quarter of their entire business, with the rest of it being automobiles, of course. And that's a great sign, because vehicle sales actually fell by 7% in the quarter. So this really helped their total revenue growth stay positive because of those other parts of Tesla's business. And that's why I always say, for Tesla to be successful long term, it's got to evolve. It's got to be this more of a tech company. Can't just be an automobile company. They've got to have these other pieces that help it out. And of course, a lot of those pieces are more long term, though. We'll talk about that in just a second here too. But let's just dig back into this report a little bit. So on top of that, free cash flow, it returned to positive growth. That's a good sign, especially heading into the second half of the year, which is usually stronger for Tesla. But then they also noted again, record energy deployment, plus also that the Cybertruck is now ramping up in production. It actually became the best-selling EV truck despite only recently launching. That's a pretty big deal there. It's beating Rivian. It's beating the Ford F-150 Lightning. I mean, I remember when everybody was saying that those would be Tesla killers. Well, Tesla just launched the Cybertruck. I mean, we're barely seeing it out on the road. It's barely ramping up in production, and it's already the best-selling EV truck. So that's another positive sign. Kind of shows it's like, okay, what is Rivian doing? What is so special about them? They can't even beat the Cybertruck. That's not very impressive in my opinion. Anyway, don't mean to be a hater on that, but just kind of sharing my opinion on that. Anyway, they also noted that the Optimus robot, which of course Musk has said in the past could be the biggest part of their business long term, well, it began performing tasks autonomously in one of their factories. That's another great sign there, because that could really help improve their margins. We talked about how their margins are struggling right now. A lot of the headlines surrounding Tesla is all around profitability and margins. If you can start having your robots perform a lot of your tasks autonomously, that's going to really help you out with your margins because you don't have to pay a robot anything, right, to do those things. Anyway, during the earnings call, by the way, Musk also tried to give some optimism on both the robot as well as the upcoming robotaxi and cheaper mass market vehicles, saying that the bot will ramp up tasks for them in factories next year and could start selling to other businesses by 2026, while the robotaxi event has been delayed to October 10th so that he can, quote, add a couple of things to it. So, of course, we had previous plans for that, but that's just kind of how Elon Musk operates. He always overpromises in terms of delivery dates. Those always tend to get pushed back. So it just kind of is what it is, but hopefully whenever they do fully launch, they perform well, right? That's kind of the idea. As for the cheaper vehicles, well, Tesla also said, quote, plans for new vehicles, including more affordable models, remain on track for start of production in the first half of 2025. These vehicles will utilize aspects of the next generation platform as well as prospects of our current platforms and will be able to be produced on the same manufacturing lines as our current vehicle lineup. So that's really where I think if you're investing in Tesla, you're not really investing in them for that maybe traditional EV story anymore. In fact, vehicle sales for them have been relatively flat in recent quarters. And I do think that, I would say, put it this way, while I do think that those will return to higher growth over time as EV adoption ramps up and the macro environment becomes more favorable, but right now interest rates are just way too high. It's way too expensive to buy EVs, and we've been seeing that with a lot of companies pulling back EV investments. We'll talk about that in just a second a little bit with GM and Ford, but I think that will recover over time. But really, if you're investing in Tesla, you're investing for all these other things that they're trying to do: the bot, the energy, the cheaper upcoming vehicles that could be produced on, well, that will be produced on their next gen platform that should be more cost effective for them. And then also, of course, autonomy and the robo-taxi service. That's where you really start to bring in software like margins that could really help them perform much better long term. And I think that's what you really want to be looking forward to if you are an investor in Tesla, which not everyone is. I do own Tesla stock myself, but that's kind of what we're looking forward to as shareholders. And also, by the way, just they continue to do more work in AI. Actually, we have some updates on this too in the quarter, because during the earnings call, they asked Elon Musk if he would consider for Tesla to be investing in his private AI company that actually built Grok. That's a generative AI platform from Elon Musk. You've probably heard of it. And Musk actually, typical Musk fashion, he just ran a poll on X, and he asked people if they would want Tesla to invest $5 billion into his AI company. They voted yes, and so he said that he would talk to the board about investing $5 billion into this company. So that's something else that is kind of going on in the headlines right now too. Obviously, people have mixed feelings on that. Some people think that it shouldn't be happening. It's like Elon Musk is using Tesla to invest in his own company, but other people like the fact that there could be some more integration between AI and Tesla, and it might help them. So anyway, but that's just another update that we have from this recent earnings this week. Now, looking at the stock here, in the meantime, of course, times are still going to be looking very rough right now. And because of what we saw in the reports, the stock actually fell over 11% this week, leaving it now down over 40% from its highs. Personally, I already did all of my buying in Tesla stock, so I'm not buying anymore at this time. I bought in at much lower levels. That's for my larger private portfolio. I do, of course, have a public community portfolio where you guys vote for things and have more insight and oversight over it. And for that portfolio, you guys did actually vote to add Tesla stock to that portfolio. So we did do some buying of Tesla this year. But in my personal portfolio, I'm not really touching. I'm just kind of holding the rest of my Tesla position long term for what they can do hopefully in the future. Not so much what they're doing right now. Right now times are tough, but for what they can hopefully do in the future. Anyway, having said that, of course, Tesla's couple of their big competitors, GM and Ford, they also both reported this week. And I think it just kind of showed why I personally like GM so much more than Ford and other legacy automakers. Now, full disclosure, I have been buying GM stock myself, not as a futuristic play on AI and tech like what I envision Tesla being, but more so as just kind of a very cheap and beaten down automaker that I think is a value pickup at these levels and is also making some of the right moves, slowly, gradually transitioning over to EVs and even autonomy for the longer term, where I think the market will be big enough to support not just Tesla, but some other players too. And I think GM could be one of those. But Ford, on the other hand, just kind of seems stuck in the past to me, and it's not very exciting at all, as they actually posted their worst performing day this week since the Great Recession. Guys, the stock fell by over 18% on earnings day, as they not only missed analyst estimates, but despite having revenue growth of 6%, their adjusted EBIT actually declined. Their adjusted EBIT profits, it declined by close to 30% year over year. Now, this was in large part due to higher warranty costs that have been plaguing the company for years. In fact, this most recent quarter's warranty costs were from vehicles from 2021 and prior. And while they didn't specify the exact amount, they did say that it was like over $800 million, getting kind of closer to $1 billion more than the previous quarter. So it's been costing them even more. And I don't know if you guys have ever heard of this joke, but there's a saying that I kind of grew up with when I think of Ford. I'm debating if I should say it on here because I don't want to talk badly about Ford, but it's just a funny little thing that I used to hear growing up, that Ford, the name Ford, stands for fix or repair daily. And it's because I had friends that had Fords, and they would break down quite a bit. I'm not saying that happens anymore. I'm just saying that used to be kind of a thing. So they've had a bit of a reputation hit because of that. And right now it seems like they're still dealing with repair costs, warranties, and stuff like that. But by the way, they actually did address some of this during a media briefing. They said that they're trying to invest more now into new initiatives to improve the quality of their vehicles going forward, so that hopefully, these warranty costs can come down, because they seem to really be taking a toll on them, which is pretty interesting. Anyway, Wall Street seems to not be buying their story, as they sold the stock down over 22% this week, leaving it now trading at also one of the lowest prices of the past decade. Now, on the other hand of that, GM stock, on the flip side, GM, which again, full disclosure, I do own it, but they just seem to be performing much better, with this quarter beating analyst estimates on both the top and bottom line, while also putting up much higher growth than Ford, with more than a 7% rise in sales, a 14% rise in net income, and a whopping 37% rise in adjusted EBIT too. So kind of like the complete opposite there in terms of profit growth. And yet, despite also raising their guidance for the year, Wall Street actually sold down the stock by over 10% this week, leaving it also down about a quarter of its value from the top. This was mostly because of some struggles that they're seeing in China. It's been hurting them for a while now. Their China business has not been doing very well. And so they're now having to make some restructuring deals to adjust to that. And on top of this, they're also scaling back a little on EVs and autonomy, just like Ford and a lot of other automakers out there that are struggling to grow with EVs because of the challenging macro environment. They're just not seeing adoption take off large enough. Again, that will very likely, almost certainly, change longer term. But in the current moment, these companies are just much more profitable with ICE vehicles than they are with EVs. So it's kind of just a short-term adjustment, which, for what it is, I agree that Tesla just continues to go all in on EVs. I agree with that. But at the same time, it's not the worst thing in the world for a company like GM if they can also lean on ICE vehicles during weak periods of EV sales, which is currently where it's at right now. But longer term, again, that is going to change. So you do need to go all in on EVs, but it's, just a little bit slightly different strategy than Tesla's. And I don't know, I think both are kind of fine. Anyway, these issues, I think, could hopefully be resolved longer term. And overall, when looking at GM stock, I just can't ignore the fact that it is so incredibly cheap. I mean, you're talking about a forward PE ratio and PEG ratio of less than 5 and 1 respectively, which by the way is even cheaper than Ford, despite what I feel is much better performance. I mean, they do much better sales. I think their business is much better diversified. I like their models more. Personal opinion, that's subjective, but I do. And they seem to be performing much better. I mean, GM, in fact, last year was number one in America in basically every category. They were number one in all auto sales, even beating out Toyota. And they even beat Ford on trucks and SUVs, which have, we always hear about Ford, their trucks being the best selling trucks. Well, no, GM actually beat them. And because of these reasons, because of that better diversification, the better performance, yet the stock price being down and even cheaper than Ford, I just think the stock is a decent pickup at these prices. So I kind of like GM, but that's just my opinion. I know a lot of people hate GM stock, by the way. I get lots of comments telling me that GM stock is a horrible stock. I happen to like it. We just have to disagree on that one. But anyway, the last stock that I'll just quickly mention here, we had the internet tech giant Google, who of course, one of my favorite stocks. It's been one of my favorite for the past couple years. It's been really my number one favorite. And they too reported this week, and you can kind of guess how that went. They too had a poor performing week with the stock falling almost 8%. We've been seeing this with a lot of companies so far in this quarter. But in this particular case, this was despite the fact that I actually thought Google had an outstanding earnings report, as they not only beat on both the top and bottom line, which they tend to do every quarter, by the way. It's pretty astonishing that they can continue to beat estimates, because you got to figure estimates are probably going up and up and up because they're always beating. So analysts keep raising it, and they just keep beating them. It's kind of crazy, and it just shows how well run they are. But even more impressive than that is how they're still growing at a double-digit rate despite their already massive, gigantic size, with sales rising about 14% and net income profit soaring by close to 30%. That's incredible for their size. So why then did the stock fall? Well, the only area that they actually missed analyst expectations on was in YouTube ad revenue, which Wall Street hated to see. By the way, other parts of the business are doing amazingly well. Search and cloud put up record numbers, and even YouTube was still positive growth in the quarter despite horrible macro conditions where advertising from companies is scaling way back because of the environment, but yet Google is still putting up growth. So I think they did really well, but Wall Street just didn't care, and they sold down the stock regardless. Now, granted, I will give you, the stock was already very high to begin with. This is a company here, a stock that is valued north of $2 trillion. So you're basically just going to have to be putting up incredible, perfect numbers every quarter if you want to keep the stock elevated this high. I think that's kind of what we're seeing here. But I still think that it was a bit of an overreaction for the quarter in terms of really good performance. The stock actually going down doesn't make a whole lot of sense. And by the way, it was also revealed, if you want to talk about YouTube's performance, it was revealed recently that YouTube is watched more than any other streaming platform in America, even on televisions. How crazy is that? Even on the big screen, on the couch at home, YouTube still surpasses Netflix and Disney and HBO and everything else in watch time in America. That's insane. That's crazy to think about. Anyway, Google, still my favorite stock in the market, and I think it's pretty much always a buy if the time horizon is long term. But yeah, that'll just about do it for this week's update. I hope you enjoyed it. Let me know your thoughts down below in the comment section. I'll probably do another update. If you guys want it, I'll probably do another update next Saturday too. But for now, I will catch you in the next video. All right, thanks for all your support, everyone. Hope you're all doing well. I'll catch you in the next one. Take care, everybody. Bye-bye.